So at the end of the month, how often are you paying off the full balance of your credit card? A new report finds that half of all Americans with a credit card say they can't afford to each month, and it comes as the price to carry that balance has never been higher. The average credit card interest rate hovering around 25%, ultimately trapping so many of us then in this vicious cycle. We talk about it all the time. In Your Corner is all about finding practical ways to solve everyday issues, and debt is just about as universal and widespread an issue as it gets. Thomas Nitzsche with the nonprofit credit counseling agency Money Management International is our guest. You might recognize him. He's appeared in several In Your Corner reports here over the years on dealing with debt. And today he's here to talk about the mistakes that we make when dealing with debt and some of the different practical approaches that we can take to start paying it down. It's good to see you, Thomas.
Yeah, thanks for having me. It's great to be here in person.
In the flesh.
Yes.
We were just talking before this, like we've known each other for years. We've done stories for years. It's always been in the Zoom boxes.
It's nice to get out of the box.
And I'm just realizing now that we've started recording, I told you I was going to take this thing off. And here I am with the official cardigan on. This is not... Anyways, all right. Money Management International. You guys are a nonprofit. Give people the gist. What do you guys do?
Sure. So MMI is one of the largest and oldest national nonprofit housing and credit counseling agencies in the U.S. We essentially help people achieve financial goals, primarily around getting out of debt, achieving home ownership, staying in their home, whether that's an apartment or if they have a mortgage. We're really focused primarily on low to moderate income folks, although we serve people from all different demographics. And it's primarily around debt-related issues, whether it's unsecured or secured debt.
What does it mean when you say you're a nonprofit? Are people having to pay for these services? How does that work?
Sure. So many of the services we provide are completely free. We're funded by grant funds. We receive money from the Department of Housing and Urban Development to provide housing stabilization services. We get private grant funding. There are some services that have some nominal fees. For example, some of the clients you've met with in the past were debt management clients where we help them long-term, usually about 4-year program. We help them climb out of debt by getting their interest rates down with their existing creditors. There's a nominal fee. It averages about $25 a month, helps us keep the lights on.
I think it's very easy to, and admittedly, I probably have done this from time to time. People who are in debt, you paint them as irresponsible. They don't know how to handle their money. They overspend, they whatever. And I think that there was a poll that even found that most people would assume that that's the case, either because they're in debt themselves or because someone else is in debt. Well, I was just irresponsible with my money. That's a cop-out.
It really is. And I think I had that same perception before I came to MMI. When I was thinking about taking the job, I'm like, oh, I'm going to be counseling people that were just really bad with their money. Right. And as I started counseling people, I came to realize that, oh my gosh, that is really not the case. It is that life happens. 1 in 5 people that come to us because of a medical issue. Well, you didn't ask for a medical issue. You took time off work to be able to care for a family member, or you couldn't work. You had a high deductible. You had a lot of out-of-pocket expenses. You had high-cost medication. Those are all things that contribute to that, either a reduction of income or extra expenses that you weren't planning for. And so when you start to think about unsecured debt as more of a really just a societal issue, that it's not something to be ashamed about. It is just that you needed to rely on something and you turn to the credit cards because it is a relatively safe, familiar tool that you use every day. And it's very easy to get overextended when these life circumstances happen. You have a home repair, you have a kid that's sick, there's so many things that can happen. Your car breaks down.
Well, yeah. What's the stat that's out there? And I don't want to misquote it, but it's something like most Americans are like, $1,000 emergency away from debt or worse.
Right, because we don't prioritize emergency savings. Yeah. A lot of us don't do that. We tend to spend what we make, be very hand to mouth. The check comes in, the bills go out, and there's not really much margin there. Some people do have retirement funds, 401ks, 403bs, whatever, but not money just set aside in emergency savings that you would want to pull on, turn to instead of a credit card when a financial emergency happens.
It's been, as I've done stories on this, and I've spoken with people who are dealing with debt, who have gone through you guys, who've learned how to manage it and pay it off. it has become very apparent to me that for a lot of people, it was not something that they were trying to do or intending to do or want. They don't want to be in that spot. They feel ashamed that they even got to that spot. And I always credit them. I thank them so much at the end of each interview, like for even being willing to talk about, not just talk about it, go on camera and talk about it. But there is such power there in sharing that, and again going to like breaking down that stigma. If we just need to talk about it.
Yeah, I mean, I think it's really fascinating because I'm so fortunate to get to work with these clients every day. But it is fascinating to me that only about 4% of the people that we work with are willing to talk about it publicly, and that is despite us having a very high satisfaction score, right? These are all clients they're all very satisfied with what we do for them, but only 4% of them are willing to talk about it publicly. And it's because of that exactly. There's a stigma and shame. They don't want family members or friends or anybody, work colleagues, to know that they got into a lot of debt, even if it was at no fault of their own. It's just such a stigmatized topic. People would rather talk about almost anything than debt.
I did a whole podcast episode on this. Like, people would rather talk about religion and politics and like all of
Vaccines,
the other taboo things.
Sexual health, like
everything else that you would feel like ick and uncomfortable, more than money.
Yep.
And it's this sort of deep psychological
identity. It's our identity.
We tie our self-worth to our net worth.
Yep.
And so if you're dealing with a money issue, that's a you problem that we internalize deep down, right?
Yeah. I did something wrong, or I let my family down,
or I'm less than,
Yeah.
because I can't pay my bills.
Right.
Not that you fell on a hard time or something came up that you weren't prepared for.
And I think the past few years, if anything, have just showed us that, like, listen, cost of living has gone up so much. Inflation has been high for a long time. Wages haven't kept up with that largely, especially for low to moderate income folks. And so there is no shame in this game, right? Like, and fortunately, a lot of what we see is a lot of our younger clients don't feel that same level of stigma and shame as the older clients, because they've grown up with this financial stress being such a part of their lives, starting with the Great Recession, as a kid, they were with Great Recession, and then up through current times, through COVID and all that.
It is a generational thing, right? Like, my parents and grandparents be like, it's just not something you talk about, or you certainly never ask someone like, how much money they make or what they do. It's none of anyone's business. And I've found, among my, friend circle and even, my younger siblings who are, it's all on the table.
Right.
Let's talk about it. And I'm sure that has something to do too. I mean, people talk about it. You see it on TikTok. People are much more open on these platforms now about, sharing what they've gone through. And so there is a very interesting generational divide there, isn't there?
Yeah. And it's not just with debt either. It can be on the income side. Like, if you don't talk to people about, like, friends, family, colleagues about, what you're making, like, how are you ever going to know if you're, out of whack, or if there's something, that shouldn't be happening, right? Like, so, there's
you don't know
reasons about why it's stigmatized.
You don't know what you don't know. And for a lot of us, it's put us at a disadvantage.
Yep, absolutely.
Let's talk about some of the biggest mistakes that people make when dealing with debt. You hit on one of them, is just, first of all, waiting too long even to seek help, right? So, like, what happens then when people come to you?
Inaction is one of the leading causes of more financial stress, and not finding a solution. And there's never been a better time to inform yourself and get educated about what your options are. You've got ChatGPT. We've seen like a 7-fold increase in the number of people coming to us from ChatGPT over the last year.
Really? So what do you mean? So people going to...
Yeah, they'll just start to have a conversation. Listen, I'm in a lot of debt. How do I start to pay this down? And ChatGPT can come up with strategies on, hey, what's your income? What type of debt is it? What are the interest rates? It'll ask those follow-up questions similar to what a counselor would do.
Sure.
And start to give people some structure and say, oh, well, it looks like you really just need to tighten up your budget. You really need to try the snowball method or the avalanche method. List out your creditors by their balances, by their interest rates. Contact your creditors, ask them for a lower rate. That's something that a lot of people don't realize they can do. But, a study found that about 3/4 of people who asked their creditor for a lower interest rate got one. And on average, they shaved off 6 percentage points. Doesn't sound like a ton, but when you're talking about a lot of debt over a long period of time, 6 percentage points can make a huge difference.
You and I talked about it when the president had proposed putting a 10% cap
Right.
on credit card interest rates,
Yeah.
and it's the fact that a lot of people don't realize they might be able to do that themselves.
They
in
can,
some
yeah. They
cases.
can either work with the creditor directly or through a nonprofit to get it down.
So going back to the Chat GPT thing, so they're having this conversation. Does Chat GPT then refer people to
Yeah.
an MMI or
Yeah.
similar?
Yeah, they do. It'll say like, it sounds like you could use some help from a credit counselor.
Mhm.
Here are some of the ones we recommend. The other really good resource is the debt-free community on Reddit. A lot of people don't think about Reddit as being a resource for this, but there's a whole community of people who are either working towards becoming debt-free or who have already become debt-free and are trying to help others and pay it forward and say, hey, this is what worked for me. And you can go in there anonymously. The great thing about both of these places is that it's anonymous.
Going back to the stigma,
Right.
right?
Yeah. So if you're not ready to have a conversation with another human being yet, or do so identifying yourself, those are two really good places to get started.
How many people do you find come to you guys and they maybe don't even have a full grasp on how much debt they're in?
Yes.
Is that common?
Yes. Yeah, they've not opened their bills in a while. They've not looked at their credit report in a while. It's sort of a head in the sand sort of situation. And they're just hoping it's going to somehow magically get better on its own. And one of my favorite counselors used to say, hope is not a financial plan. Be great if it was, because we all have a lot of hope, right? But you have to start taking action and get your brain around how much debt is this? What are the interest rates? What are the balances? What is the status of the debt? Is it still with the original creditor? Is it in collections now? Because all these details are going to matter when you come up with a plan on how you're going to repay it.
What are some other common mistakes that you generally see from clients?
One that is really perpetual and that I would see a lot when I was counseling people myself is that they would get involved with a for-profit debt settlement company or a credit repair company, not understanding how they worked. And then things would start to go south. Creditors weren't being paid. They were getting collection calls. They may have even gotten a summons to appear in court. And then they come to us for a second opinion. And it's really heartbreaking to be the second opinion guy, because at that point, a lot of times the credit damage is done, the accounts are already in collections, and it's a really difficult situation and a conversation to say to somebody, hey, I really wish I could have talked to you 3 months ago.
Yeah, like
when
that ship has sailed.
The ship has sort of sailed here, and now we're talking about a very different set of solutions than we would have been 3 months ago.
Okay, let's dive into that a little bit since you brought it up, because this people hear the term debt relief, and it's sort of this large
umbrella,
encompassing umbrella with all these different terms. You mentioned settlement, you mentioned consolidation. They all serve very different purposes and can have, to your point, very different outcomes.
Very different results. They all sound so similar, but they are so different.
So let's start. Can we start with settlement?
Yeah. So debt settlement is basically where you're negotiating on the principal balance. That's the amount that you originally owed. How much you owe them right now is the principal balance. In a settlement, you are trying to negotiate that number down, usually to about 50% of however much you owe, to get the creditor to agree to that lump sum payment, right? But the thing is with that is that the accounts have to be in collections. They have to be in default. The credit damage at that point is usually already done. So it's not that settlement is always bad, but it's most appropriate for people who are already in collections. So if you had a layoff, let's say you were laid off last year, you had to stop paying your credit cards in order to keep a roof over your head and keep, your transportation and food on the table, right? Totally understandable. The credit cards all got charged off. They're in collections now. Now you're reemployed. Great. You've got some extra money every month. Awesome. Let's save up some of that money over time and then offer the creditors, the collection agencies, a settlement. Because at that point, the credit damage is already done. You might as well try to save a little money in the process. Now, the only things to keep in mind with that, though, are you can get a 1099 at the end of the year. At tax time, you can get a 1099 for any amount that was forgiven. So if you have $10,000 debt, you settle it for $5,000. The other $5,000 can be declared as income to you. So you have to report it at tax time. So that's one thing to keep in mind.
Okay.
The other thing to keep in mind is if you work with a settlement company, they will typically charge anywhere between 15 and 25% of whatever the original amount
Got fees.
was.
They got to make their money.
Yeah, right. And the fees are fairly expensive. So if your accounts are already current, it usually doesn't make sense to intentionally, strategically default on them in order to get a settlement, because you're going to have to pay the taxes, you're going to have to pay the settlement fees. By the time you do all the math, you're not going to save all that much money. So it's not that settlement's always bad.
Sure.
It's just that there's a segment of the population that it's right for.
Yeah.
And sometimes people try to skip ahead. They're like, I'm just going to settle this when their accounts are already still current. So what we try to do at MMI is help people remain current, because our biggest concern is helping people maintain a good credit score, improve their credit over time, not do things that are intentionally going to damage it.
You don't want people to like stop paying.
We
their
don't want people
bills.
to intentionally default just to try to get a settlement in the future, because it's not in your best interest for your credit.
There are some predatory practices in this area too, aren't there?
Right,
That
right.
can wind you're in hot water.
Quick and easy, settle for pennies on the dollar. You know, they got a lot of the celebrity spokespeople. They have huge advertising budgets. And so essentially they just don't educate people properly up front. They don't explain that, you know, all these accounts are going to go into collections. You're going to get collection calls. Your credit's going to be damaged. You might even get sued. They might try to get a garnishment or a lien against property to collect on it. And so then people will sometimes come to us for a second opinion, and we then have to educate them as to what they got themselves into, what the options could have been had they come to us a little sooner, and then a path forward. What happens now?
So you got settlement.
Right.
Then there's consolidation.
Consolidation loans. So people who have good credit can talk to a bank or credit union about a consolidation loan. That's where you take out a new loan. It's a new line of credit to pay off higher interest credit card debt. So the new loan probably has like maybe a 10% interest rate, and you're paying off credit cards that have a 30% interest rate. You're consolidating the payments, getting them all paid off. You have just one lump sum payment. That's great if you can stick to the payment, and if you also can find the discipline not to continue to use the credit cards.
Right, because now you've got two debts.
Right,
Yeah.
because if you continue to use the credit cards, then you're going to end up right where you were. You're going to end up with the consolidation payment and the credit card payments. And interestingly enough, over the past 5 years, we've seen a significant increase in the number of people coming to us with both a personal loan and credit cards on their credit report.
So they've already tried to consolidate.
Meaning that in the past they have already tried to consolidate, and they have then racked up more credit card debt, and they're coming to us with not just credit cards but a personal loan and credit card debt.
Yikes. So then, where do you go from there?
Right. And it depends on who the credit cards are with and who the personal loan is with. Some personal loan companies will work with us in a debt management plan. Most credit card companies will work with us in a debt management plan. On average, that plan gets interest rates down to around 6-7%, consolidates the payment, much like a consolidation loan, but without a new loan. We're just working with the existing creditors, which brings us to the next option, which is a debt management plan through a nonprofit like MMI, where we work with existing creditors to get the interest rates down, consolidate the payments into one. You make the payment to the credit counseling organization. The credit counseling organization disperses the payments to your creditors every month. The key word there being every month.
You got to keep on it.
You got to keep up on the payments, and the organization you're working with, you should confirm, is going to be making payments to your creditors every month, because that's one of the biggest tells between a debt settlement company and a credit counseling organization. Are you going to make my payments to my creditors every month?
All right. So make sure that the bills are still getting paid at the end of the day.
Right.
And usually that will be accompanied probably by, there's still a fee there, right? To get into one of those debt management
Right.
plans?
It's typically a nominal fee versus, and it's a different fee structure, right? Like we mentioned earlier with a debt settlement company, it's usually a 15 to 25% of however much debt you enrolled.
Yeah.
A debt management plan is always just a flat monthly fee. It averages about $25 a month. And you just pay that every month for as long as you're in the program. And the beauty of the program is you don't have to be in it for any certain length of time. So if you get a financial windfall, you get a tax return, you get a better job, you get an inheritance, you can pay off the debt management plan early, and you're no longer paying that monthly fee.
Get that out of the way, be done with it.
Yep.
And then beyond that, then people will just file for bankruptcy?
Yeah, a Chapter 7 or 13 bankruptcy. A Chapter 13 has a repayment portion to it. You're paying back a portion of the debt. A Chapter 7 is like a fresh start. You're just a clean slate. All the debt is just wiped out. You have to do what's called a means test. The attorney will do a means test with you to determine what assets you have. Your financial ability to repay will determine what chapter you can file. But that's sort of an option of last resort. It's sort of, and in I would say ascending order, it is a DIY, debt snowball, debt avalanche, working with your creditors directly. Then you've got a debt management program through a credit counseling organization. Then you've got debt settlement. Then you've got bankruptcy. That's sort of the flow chart, if you will, in ascending order of like
Depending on where you're at,
depending
how
on where
deep
you're
you
at,
are
how
in.
deeply are you in debt.
Okay. Wait, so you just mentioned this, I've heard these terms, snowball and avalanche. We're not talking about
Yeah.
weather here.
No.
Those are two different approaches to paying down debt.
Right. So those are both DIY approaches. If somebody feels like they can do it on their own, they just need to get better with their budgeting. They want to pay down their debt. They can do it strategically by either a debt snowball, which all that means is that you're listing out your creditors by the amount of debt you owe. Starting with the smallest debt up to the largest amount of debt, you're paying as much as you can to the smallest debt every month and just minimum payments on the rest. And the reason people like this approach is that it gives some emotional satisfaction quickly. If you're starting with your smallest balance debt, it pays off pretty quickly. If you're making the most you can to that one, it gives you sort of an emotional boost. I can do this. Let's move on to the next one. I can do this. Keep making minimum payments on the rest and just attack them from the lowest balance up.
Okay.
The avalanche is where you list them out by interest rate, from highest interest rate to lowest interest rate. And this is the best approach, mathematically speaking, to save you the most in interest. It's usually a good idea to first call your creditors and ask them to lower the interest rates, and then do this self-help exercise, right? List them out by interest rate. Pay as much as you can to the highest interest rate and the minimum payments to the rest. That way, you're attacking the debt with the highest interest rate, paying it off the quickest, saving the most in interest long term.
So snowball, kind of the tiny to the larger, versus avalanche, you go big, you start big,
Right.
and kind of work your way down.
Work your way down to the smaller APRs, right?
Okay, and it just kind of depends again on like how
What
bad.
motivates you? Like,
Okay.
I always like to say there's not a bad approach here. If you're focusing on your debt and you're going to DIY it, you have the ability to DIY it, you have enough to make minimum payments and then some. I think that's another really good indicator of the option people should pursue. If you can't make your minimum payments, or if you're struggling to just make your minimum payments, then you probably need some more help. You should probably talk to a credit counselor. You should probably talk to your creditors. If you have enough to pay all your minimum payments and then some, then it's a good idea to look at a DIY, an avalanche, or a snowball. Just really get focused and paying that debt down on your own.
I guess it's like, with anything, if you're going into something, you want to find something that you're going to be able to sustain that's actually realistic. Because you had mentioned, so people coming into you, an increase of people coming into you that have already tried to consolidate loans. They've got a personal loan. They're still racking up debt. Clearly something didn't work there in the
Right.
plan.
Yeah.
So finding something that you're actually going to be able to stick to.
Right. And one thing about a debt management plan is that included accounts do close. So there is sort of a physical, cutting yourself off from the cards, sort of going on a diet, so to speak, a financial diet, where you're just like, okay, I'm going to leave a card out for emergency use. It's already paid off, or maybe it has a low balance. I'm going to leave that one off the plan. But any of these high rate or high balance, high interest rate credit cards that you include in a debt management plan, they do close. So it sort of forces people to use cash more, use their debit card more, not get overextended while they're trying to pay down debt. Because if you just take out a consolidation loan and you still have all your credit cards open, it's very tempting to swipe them again.
Sure.
You want to go on vacation, you have an emergency, like you're going to turn to the credit cards again while you're trying to pay down debt on the consolidation loan.
What is the average length usually that it takes people once they come to you to get their debt paid down?
The average person comes to us right now with about $33,000 in unsecured credit card debt. On average, a debt management plan lasts about 4 years. It can go up to 5, sometimes even 6 if needed. And some people can pay it down sooner. Some of our, about I think 12 or 15% of our clients pay their debt management plan off in 2 years. Mm-hmm. So you can pay it off as fast as you can or as you would like. But the maximum is typically 5 or 6 years, and the average is about 4.
Well, so I'm really excited because we're going to be partnering with you guys here at CBS News Philadelphia, bringing in several of your counselors we're going to have on site for a day-long event where people can contact us directly, can speak directly to a credit counselor for free, and get some of their questions answered. And then, feel free to, we'll have the comment section open on this video if there are just maybe general questions that you have that you're looking to get answered, or you need advice on who to get in touch with, put those down in the comments. We can get those answered as well.
And if somebody sounds like they're a good candidate for counseling or a debt management plan, we'll give them more information about that and how to get started.
Kind of ripping the Band-Aid off, getting that initial conversation.
Start the conversation, yes.
Going, right?
Yeah.
We're all dealing with it, probably, in some form or fashion. So let's stop trying to ignore it or bury our head in the sand about it.
Yeah, if you can just open up and start to have a conversation, I found it was so helpful when I was counseling people that I'd been through these situations myself. I had just bought a house before the Great Recession, and then was laid off, had to go through a mortgage modification, had to receive counseling, had to do an individual development account to make repairs to the house and be able to afford it, had to downsize my car, had to figure out a way out of credit card debt, had to deal with student loans. There's a lot of pressures on today's consumers. And with today's cost of living, you just simply can't afford to be carrying a lot of high interest credit card debt. There just isn't room in the budget.
Thomas Nitzsche with Money Management International, the nonprofit credit counseling agency. Always good to pick your brain to talk about this, and I really appreciate you coming on.
Thanks.